Welcome back to Alpha Recap. It's Marcus here, and we're coming to you after the close with a quick, energetic roundup of today's sector moves. As always, if you have questions, you can reach us at stockalpha.ai and use the Q&A feature to ask us directly. Today, we want to dig into why capital rotated into infrastructure and AI, while crypto, materials, and parts of cannabis cooled off.
Thanks. Glad to be back. There was a clear theme on the tape today. Investors moved toward durable, infrastructure-style opportunities. Storage, solar plus storage, industrial real estate and data centers, and toward AI infrastructure. At the same time, higher beta, sentiment-driven areas like crypto and some materials names underperformed.
Let's walk through the headlines that really set the tone. You and I were both watching a major storage announcement and a big AI allocation. Summarize those for listeners.
Sure. The most concrete item was a $1.5 billion utility-scale storage project announcement. That was a tangible sign that lenders and off-takers are backing long-duration projects. On the AI side, a large venture firm committed about $1.7 billion toward AI infrastructure. That kind of concentrated allocation fast-forwards demand for cloud providers, chips, and data center capacity.
So those two headlines pushed money into utilities, real estate, and technology. How did the market price that?
Utilities finished the day up as renewables and storage stories grabbed investor attention. Real estate also finished the day up, specifically industrial names and data center landlords because of leasing momentum and big groundbreakings. Technology saw gains as well. AI funding and multi-year cloud deals kept buyers interested.
What were the other big corporate moves that helped the story?
A few corporate items were notable. There was a reported about $5.1 billion data center transaction that reinforced the infrastructure narrative. Amazon reported a roughly 30% jump in same and next-day deliveries, which links directly to industrial real estate demand. Clorox completed about a $580 million ERP overhaul, which signals better digital execution for some consumer names. And on the banking side, Santander announced about a $12 billion US acquisition, which created chatter in financials around M&A.
Okay, so while those things were drawing capital, the other side of the ledger got hit. Crypto was one of the main laggards today. What did we see there?
Crypto was under pressure. Bitcoin faced selling, Ether and other protocol tokens showed bearish setups, and there was a reported drop in futures open interest of about $55 billion. That's a really large de-risking by leveraged players. On top of that, Tether trimmed fundraising targets, which raised funding fragility concerns.
Explain the futures opening. Interest drop in plain terms for listeners who aren't deep in crypto.
Think of futures open interest as the total amount of money tied up in leveraged bets. If that number falls by tens of billions of dollars, it means many speculators either closed positions or got forced out. That reduces short-term liquidity and can increase volatility because fewer players are willing to take the other side of big trades.
Got it. Materials and mining also didn't have a great day, right?
Right. Some permitting news was constructive, but several materials companies reported earnings pressure. Projects like Project Vault received criticism, and that reminded investors of execution risk in the group. Materials remain a higher beta bet tied to commodity cycles, so any disappointment on earnings or capex can move names sharply.
Cannabis was another sector flagged as volatile. What specific signals were weighing on it?
Policy friction in places like Florida and Nebraska balanced out cultural normalization headlines. On top of that, industry tracking showed US sales across certain states were down about 3% in January, which is not what investors want to see when they expect legalization to turbocharge growth. So policy timing and real-world retail metrics kept sentiment fragile.
Let's pull back and talk themes. The article highlighted 5 cross-sector themes. Start with infrastructure spending and the energy transition. How did that play out today?
Storage, solar plus storage, and grid modernization dominated headlines, and those stories spilled into industrials and materials. The $1.5 billion storage project wasn't just a single build, It implied multi-year supply chain demand for power electronics, transformers, and construction labor. So you saw utilities benefit directly, and industrials and materials got a more mixed reaction based on execution and margins.
The second theme was AI and data center gravity. You touched on that earlier, but explain why a venture allocation matters for public market investors.
When a big venture firm deploys about $1.7 billion into AI infrastructure, that's a signal to enterprises to invest in compute and tooling. It creates a forecastable demand curve for cloud capacity, GPUs, interconnects, and colocation space. For public investors, that maps into multi-year revenue growth for cloud providers, chip makers, and data center landlords, even if near-term margins get pressured by CapEx.
Theme 3. Logistics and delivery. Amazon's 30% delivery jump was a headline. Why does that matter for real estate?
Faster delivery shortens logistics cycles and increases demand for last-mile facilities. If major retailers are cutting delivery times, they need more urban warehouses closer to customers. That helps industrial REITs focused on urban logistics and boosts leasing and rent growth in those markets.
Theme 4 was regulatory and policy risk. Which sectors were most affected by that today?
Cannabis, crypto, healthcare, and parts of finance. We saw policy questions around cannabis rollouts, pharmacy benefit manager reform chatter in healthcare, and ongoing regulatory scrutiny in crypto. Policy uncertainty can quickly reprice these groups, so investors are treating regulatory calendars as key risk events.
And the fifth theme was capital reallocation away from high beta carry. The $55 billion fall in futures open interest you mentioned supports that.
Exactly. With leveraged speculative positions shrinking, money rotated into lower volatility, cash flow-oriented areas. Think regulated utilities, long-leased industrial real estate, and data centers with contracted revenue. It's a classic move to preserve optionality for AI upside while reducing exposure to pure momentum trades.
We should go through the day's most significant moves and why each mattered, quickly. Start with the storage project. What did investors take away?
They saw a real capital commitment to decarbonization. The $1.5 billion project suggested lenders see reliable revenue stacks from capacity payments and ancillary services. For regulated utilities and independent power producers with storage exposure, that implied potential earnings and free cash flow upside over time.
Next, the AI allocation by that venture firm.
That about $1.7 billion allocation accelerated enterprise adoption. It made infrastructure names more attractive because it signposted predictable demand for compute and cooling, which supports cloud vendors, GPU suppliers, and co-location landlords.
Real estate, the Houston Industrial Project.
A 1.4 million square foot groundbreaking in Houston and continued leasing wins increased visibility into future net operating income for industrial landlords. Large pre-leases help reduce execution risk for developers and support rent growth in tight logistics markets.
Consumer, Amazon's logistics jump and Clorox's ERP completion.
Amazon's roughly 30% improvement in same and next day deliveries showed that logistics execution is a competitive moat. Clorox completing about a $580 million ERP overhaul illustrated how legacy brands can improve margins through digital investments. Both stories favored companies with strong omni-channel execution.
Crypto, again, with that large fall in futures open interest and fundraising pullbacks.
Yes, the roughly $55 billion decline and Tether's pullback reflected a deleveraging that widens risk premia. For crypto holders, that meant sizing down leverage and watching stablecoin counterparty risk closely.
Materials and mining? Why did that group underperform?
Earnings misses and critical commentary on projects weighed on sentiment. Even with some permitting wins, investors reminded themselves that materials returns hinge on execution and commodity cycles, so it was a risk-off day for the group.
Finally, finance and M&A, Santander's deal.
A reported about $12 billion acquisition in the US prompted questions about price and integration risk. Large cross-border deals can be value destructive if premiums are high, and that prompted some caution in bank peers.
Let's get practical for portfolio construction. What did you recommend investors consider after today's close?
First, tilt to durable cash flows and contracted revenue. Increase exposure to regulated utilities with storage programs, long-leased industrial real estate, and co-location data center landlords. Second, keep AI exposure, but manage timing risk. Favor diversified players like cloud providers, established chip makers, and software companies with clear monetization paths. Third, use strict sizing and protective hedges for high volatility bets like crypto and cannabis, for example, protective puts or collars. Fourth, monitor funding and liquidity signals closely. Things like stablecoin fundraising and futures open interest can foreshadow bigger moves. And finally, watch policy calendars and quarterly guidance, because regulatory rulings and earnings call guidance can reprice entire sectors quickly.
You mentioned hedges for volatile sectors. Keep it simple for listeners. When do you use options versus just trimming positions?
If you want to stay invested but limit downside, protective puts are a straightforward choice. They give you insurance for a defined cost. If cost is a concern, collars can cap upside but lower the insurance premium. If you don't want any exposure, trimming outright is valid. The key is consistent position sizing and having predefined stop rules so you don't get caught emotionally.
We also promise to walk through the catalysts to watch next week. Quick hits?
Sure. 1. Fed commentary, inflation and wage data. That will shape multiples. 2. Any Middle East developments and oil inventories for the energy group. 3. Crypto institutional products and regulatory commentary. Watch tokenization rollouts. 4. AI spending cadence and cloud operator quarterly reports to calibrate capex. 5. Real estate leasing metrics for logistics and data centers. And 6. Cannabis policy updates at the state level.
Before we wrap, give listeners 3 crisp takeaways from today.
1. Capital rotated toward tangible infrastructure and AI compute. Think storage, solar plus storage, industrial logistics, and data centers. 2. High beta and policy-sensitive sectors like crypto, materials, and cannabis experience de-risking, driven by funding pullbacks and regulatory uncertainty. 3. For most balanced portfolios, it made sense to increase exposure to structurally advantaged sectors with visible cash flows while using size discipline and hedges in the more volatile areas.
Great. Any final practical tips for listeners who want to act on today's themes?
Be selective. Favor companies with contracted revenue and visible financing for major projects. If you own speculative names, reduce leverage and set hedges. And keep an eye on funding indicators. When they wobble, price moves can be amplified across risk assets.
That's a solid wrap. Thanks for the clear breakdown. If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly using the Q&A feature and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. We'll be back after the next close with more sector-level takeaways. Good night.